guys, welcome back to Flow State Finance. I'm Arnav, and today I'm going to be talking about the cash flow statement. Let's get started.
There are two main principles behind the statement of cash flows. The first is the idea of cash inflow and outflow, and the second is more conceptual in nature. You can't spend what you don't have. Keeping these ideas in mind, let's take a look at today's agenda. In this video, we will first go over the definition of a cash flow statement. Then, we will explore its importance as a financial document. After that, we will take a look at a real-world example, and finally, we'll wrap up with a review of key ideas. A quick note here. Cash flow statement and statement of cash flows mean the same thing. It's kind of like if you were talking about someone from America, you could say American person or person of America. They mean the same thing. In this video, I'll stick to cash flow statement because it's more concise. But if you see statement of cash flows in any situation, just know that they're synonymous terms. With that out of the way, let's get right into it with the definition of the cash flow statement. The statement of cash flows is one of three core financial documents that breaks down the quantity of cash entering and leaving a company over a period of time. Just like the income statement, the cash flow statement also measures financial performance over time. That similarity is actually fitting because there is a very important relationship between the income statement and cash flow statement that we will explore later on in the video. Before we do that, however, we have to address an important question. Why does it matter? After all, it wouldn't be illogical to think that the balance sheet and income statement have everything covered, because, as you might know, the balance sheet is a snapshot of how a company is doing at a specific point in time, and the income statement tells you how a company is doing over a particular time period. So why use the cash flow statement at all? It can be difficult to answer this question in a purely theoretical manner, so let's take a look at an example. Let's talk about Billy. Billy runs a coffee shop, and he already has a pretty good coffee machine, but he wants to buy the new Espresso Extreme 9000, which costs $1,000 and will last him an estimated 5 years. If Billy has $1,200 in savings, should he buy the coffee machine? Well, if Billy wants to buy the coffee machine, we need to make sure he can afford it. Let's assume that he does buy it. How would it show up on his income statement? Think about it for a second. Think of how we do our accounting on an income statement, especially when it comes to equipment like a coffee machine. Alright, let's see what it would look like. So the problem states that this machine has an estimated useful life of 5 years, right? In the second sentence, it says he wants to buy the new Espresso Extreme 9000, which costs $1,000 and will last him an estimated 5 years. So in the income statement, you would take depreciation into account and spread out the cost of the coffee machine over 5 years. So $1,000 over 5 years would get you an estimated yearly cost of $200. Now the problem also says that Billy's buying the machine, not leasing it or renting it or anything like that. So is this actually a good purchase for him? The income statement makes it seem like the purchase is a no-brainer, but now let's take a look at the cash flow statement. The cash flow statement follows cash, not expectations, and it tells a different story. The truth is, regardless of how long the machine actually lasts, disregarding any warranty on it or anything like that, Billy's going to have to pay the $1,000 for it up front. So in year 1, he'll pay $1,000, and then in years 2, 3, 4, and 5, he won't pay anything for that machine. With that insight in mind, let's reevaluate Billy's decision. We know Billy has just $1,200 in savings, and since this machine costs $1,000, if he bought it, he'd lose most of his savings. Since buying the machine would cost Billy most of his savings and leave him on financially shaky ground, he probably should not buy the machine. As you saw through this example, there's a clear difference in how financial information can be presented. Even something simple like a single $1,000 purchase can show up in two completely different ways. So it's important for anyone looking to invest in anything, especially a business, to look at all the data available to them before making a decision. The more informed you are, the more successful you'll be. With that being said, we still haven't answered the essential question here. What does this tell us about the cash flow statement? Well, this is where the two important principles I mentioned come into play. First, the cash flow statement operates on cash inflow and outflow. If your outflow is greater than your inflow, your money out is greater than your money in, and that means you're spending more than you're making, so maybe you need to change some things about your business. The second principle is just as important here. You can't spend what you don't have. If you have $10 in your bank account and you have a $100 bill due tomorrow, it doesn't matter how much money you're scheduled to earn next week, you'll be in trouble. That's what makes the cash flow statement such a crucial document. It looks at money as it is, not what it could be or what it should be. And in doing so, it gives a clear picture of how sustainable a company's business operations are, as well as what they should change to make their business more financially safe and sustainable in the future. Alright, hopefully that example has helped you achieve a greater understanding of what the cash flow statement is and why it's necessary. Now, let's take a look at a real-world example to give you some more practical insight into the cash flow statement. The sample we'll be looking at today is from Facebook. Before we go any further, it's important for you to know that cash flow statements are broken into three main categories: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Let's go through this example and analyze each section in more detail. Alright, so here's the first section of Facebook's condensed consolidated statements of cash flows for both the last 3 months and last 12 months of the 2018 and 2019 fiscal year. We can see that it starts with net income. That's the number at the very top of the cash flow statement. Right underneath that, it says adjustments to reconcile net income to net cash provided by operating activities. This probably sounds really confusing, but bear with me and hopefully it'll start making more sense. So think back to our example with Billy and his coffee machine. The income statement spread out Billy's costs over a 5-year span, while the cash flow statement had a $1,000 cost up front, and that's because of the way the income statement works. Its job is to give you an idea of all financial aspects of a business over a period of time, and since there's a lot of gray area in the way businesses operate, it has to adapt. It's important for you to recognize that the bottom line on an income statement is net income, and coincidentally, the figure at the top of the cash flow statement is also net income, so there's a connection there. Remember that the net income is found by taking the revenue, or earnings, of a business and subtracting things like depreciation from that total. However, the cash flow statement doesn't consider things like depreciation. That's what we discussed when Billy bought his coffee machine, right? That was the key difference. The income statement broke down his cost over 5 years, while the cash flow statement had him pay $1,000 up front. Since depreciation seems to be a problem, let's talk about it in more detail. This is the depreciation and amortization line item from the Facebook cash flow statement we were looking at earlier. Notice how all of these values are positive? The question is why? Why are depreciation and amortization positive? How does that make sense if depreciation is supposed to be a loss? Well, let's consider a hypothetical situation. Let's say there's a company called Green Money Incorporated that shuts down completely for a year. For the sake of this example, let's assume that they have absolutely no costs and they make absolutely no money, so they have no revenue. However, on the income statement, they'd still have some depreciation because their equipment would continue to lose value, right? Even though the company is basically shut down for a year, time still marches on, and so depreciation continues to take effect. So on the income statement, everything would be $0, except for depreciation and amortization, which would both be considered losses. In this case, let's put them as $10 and $5 respectively, so they combine to form a $15 loss in total. This makes the net income negative $15, but think about it. If there hasn't been any revenue or expenses generated, how could the company still have lost $15? Well, we know that it's depreciation, but then we still have a problem. Remember that the cash flow statement measures the inflow and outflow of cash, and since we haven't made any money or spent any money, our cash flow should be $0 for the year. But we know that the top line of the cash flow statement is net income, and our net income in this case is negative $15. So, with that in mind, will our net cash flow, the final amount of cash entering or leaving the company, be negative $15? No, that's not possible. To account for the way the income statement handles depreciation, we have to add back the value of depreciation into the cash flow statement as a positive figure. Depreciation is a non-cash expense, and so it must be added back to net income so we get a fair picture of our actual cash flow. All of those costs that depreciation is supposed to address have already been paid up front. So now we have to add back the value of that depreciation into our cash flow statement. Hopefully that made things a bit clearer. And now, if we head back to the example, you'll notice that depreciation is not the only thing whose sign is positive when it should be negative, and vice versa. Accounts receivable and accounts payable are also both flipped. Accounts receivable is money owed to a company, so in theory it should be positive because that's money a company will receive. On the other hand, accounts payable is money a company owes, so it should be negative because that's money a company will pay. But in this case, they're the opposite of what they should be. That's because, like depreciation, net income already factored them in as values that they should be. But since the money from accounts receivable hasn't come in yet, and money from accounts payable hasn't been paid out yet, the cash flow statement basically cancels them out. Next, we have cash flows from investing activities. This is the section that details the money earned and spent on a company's investments, and it includes the cash inflow and outflow from equipment, property, securities, and M&A, which is mergers and acquisitions. M&A is where a merger, which is when two companies combine, or an acquisition, when one company buys another, is located. So if Facebook were to buy a company like Green Money Inc. for $1 million, that cash expense would show up here in the investing activities section. The third and final main section is cash flows from financing activities. In a nutshell, this is the section that goes over the money earned and spent on a company's management of its financials. The items in this section are more complicated than those in other categories, but just know that they mainly pertain to the internal financial choices made by a company. So we can see in Facebook's case, they spent a considerable sum of money repurchasing Class A common stock. Class A stock is typically stock with the highest voting power within a company. So if you're a shareholder interested in influencing company decisions, you get the most votes per share with Class A stock. So that's all about the financing activities section. So here we have the final total, which, as you can see, is calculated in one of two ways. The first way is by adding up all the section totals to get net increase in cash, cash equivalents, and restricted cash, and then adding that increase to the starting value. That will give you your new cash flow. The second way is through the balance sheet, which we'll take a look at in a second. An important note here is about restricted cash, which might be an unfamiliar concept. Restricted cash is just money reserved for a specific purpose, so think of a refundable deposit, for example. Take a look at this product page for the new Tesla Cybertruck. We can see in the bottom right corner that it says due today $100, and right underneath that it says fully refundable. So if you want a Cybertruck, you have to pay a deposit today. But since it's fully refundable, someone could change their mind later, and so Tesla has to account this as restricted cash. As a company, you don't want to be spending that money on other things, and then have to look for other sources of cash to pay back someone if they decide to cancel their deposit. I mentioned earlier that there was a second way to get your final cash flow, and that's through the information provided on the balance sheet. Here's Facebook's balance sheet for the same 2 years, 2018 and 2019, as their cash flow statement. We can see that in their current assets section, they have a subsection called cash and cash equivalents. That same line item is present in the cash flow statement, and after adding in the restricted cash, we can see that we achieve the same cash flow value as before. This shows how the balance sheet and cash flow statement work closely together. Alright, we've discussed everything about the cash flow statement, so now let's quickly review the key ideas we talked about in this video. The foundational principle behind the cash flow statement is that it operates on inflow and outflow, money in and money out. Unlike the income statement, the cash flow statement deals in cash, not expectations. It doesn't matter how much money could be or should be coming in or going out, only how much actually is coming in and going out. The cash flow statement is broken down into 3 key sections: operating activities, investing activities, and financing activities. Operating activities make up the largest portion of the cash flow statement, as they're directly related to the daily operations of a business. Next, we have investing activities, which detail the money earned and spent on a company's investments, and it includes the cash inflow and outflow from equipment, property, securities, mergers, and acquisitions. Finally, the financing activities section breaks down all of the money earned and spent by a company's management of its own financials. At the very top of the cash flow statement is net income, and from there, that figure is adjusted for all non-cash expenses like depreciation, accounts payable, things like that. After all of that reconciliation is done, only then does it move on to other earnings and expenses. So that's why depreciation and amortization are positive, because net income factors them in as expenses, but the cash flow statement already counts the upfront cost. So to balance out the additional expense from depreciation, it adds that value back on. Think of Green Money Inc., for example. If they shut down for a year, the income statement would show them losing money due to depreciation, but since they're shut down, their cash flow is zero. So in order to balance that, we add back the cost of depreciation into the cash flow statement so it provides an accurate picture of just the cash moving into and out of a business, rather than also including its non-cash expenses. Finally, the last key idea is that the cash flow statement is connected to both the income statement and the balance sheet. It starts with net income, which is the bottom line on an income statement, and it often uses the cash and cash equivalents line item from the balance sheet in its final calculations. In that way, all three financial documents are connected.
That's all for today. If you learned something new, be sure to like, subscribe, and share this video. If you're interested in checking out some of the other finance topics I've covered on this channel, be sure to take a look at some of the videos linked in the description below. Thank you for learning with Flow State Finance.